Hey everyone, and welcome back to the channel. If there's one topic I get asked about more than any other, it's how to invest for retirement simply, effectively, and without getting ripped off. We're talking about your 401k and your Roth IRA, and the secret to both, for most of us, the S&P 500 Index Fund. Today we're not just going to list ticker symbols. We're going to break down why this strategy works, how to find the absolute best, lowest cost funds. So let's start with the basics. What is the S&P 500? It's an index that tracks the performance of 500 of the largest publicly traded companies in the United States. Think Apple, Microsoft, Amazon, Google, Tesla. It represents about 80% of the entire U.S. stock market value. When you invest in an S&P 500 index fund, you are simply buying a tiny piece of all 500 of those companies. Here's the key takeaway. Over the last 90 years, the S&P 500 has averaged an annual return of about 10%. No need for a stock guru or a fancy investment banker. Just by riding the wave of American business growth, you earn that average return. That's why legendary investor Warren Buffett has advised almost everyone to just put their money in a low-cost S&P 500 index fund. Now, let's talk about how to separate a good index fund from a great one. Since every S&P 500 fund is holding the exact same stocks, the only real difference is the expense ratio. The expense ratio is the annual fee the fund company charges you to manage the fund. It's listed as a percentage. A fund with a 0.50% expense ratio charges you $5 for every $1,000 you invest. A great low-cost fund charges 0.02%. That's just 20 cents per $1,000. It sounds small, but over 30 years, those extra fees compound into tens of thousands of dollars you're missing out on. In investing, lower fees equal higher returns. Alright, here are the top 3 index mutual funds you should be looking for. These come from the 3 major brokerages known for low-cost investing: Vanguard, Fidelity, and Schwab. First up is Schwab's S&P 500 Index Fund, ticker symbol SWPPX. This is a fantastic choice, especially if you bank or broker with Schwab. It has no minimum investment and a ridiculously low expense ratio of 0.02%. That's $2 a year for every $10,000 invested. It's perfect for beginners and long-term investors alike. Next is the Fidelity 500 Index Fund, ticker FXAIX. Fidelity is battling for the bottom dollar, and their expense ratio is even lower at just 0.015%. It also has no minimum investment. Now, if you're a Fidelity customer, you might also see FINILX, which is the Fidelity Zero Large Cap Index. That one has a 0.00% expense ratio, but it tracks Fidelity's own custom index, not the official S&P 500. It's essentially identical, but for most people, FXAIX is the standard dirt cheap choice. Finally, we have Vanguard's 500 Index Fund Admiral Shares, ticker VFIAX. Vanguard is the pioneer here. Their fee is still incredibly low at 0.04%. Before we move on, I want to mention an alternative, the Total U.S. Stock Market Index Fund. Funds like Vanguard's VTSAX or Fidelity's FSKAX. These include the S&P 500 plus thousands of other mid-cap and small-cap U.S. stocks. For long-term retirement savings, this is arguably a better, more diversified single-fund solution. They have similarly low expense ratios. If you see one of these in your 401k, it's a fantastic choice. Now, let's tackle the most common source of confusion, your 401k. This is where you have the least control, but often the most money. First, log into your 401k provider's website, Fidelity, Vanguard, Principal, whoever it is. Navigate to the Investments or Fund Selection page. You're going to see dozens of options: active funds, target date funds, sector funds. Ignore them. Look for one of these names: S&P 500 Index, Large Cap Stock Index, or a name that contains 500. The name is not enough. You must look at the net expense ratio. This is often buried in the fund prospectus or a table of fees. If you find an S&P 500 fund and its fee is less than 0.10%, you've won. Select it. But what if the only S&P 500 fund offered charges 0.45%? That's too high. Your best option is often the target date fund, but you need to check its fee. If the target date fund for your expected retirement year is under 0.20%, it's just a decent default choice, because it will likely contain the S&P 500 and gradually shift to bonds as you age. If all the funds are over 0.50%, your 401k plan isn't great, but you should still contribute enough to get the full employer match. That's free money you can't pass up. Now for the Roth IRA. This is your personal account, giving you the power to choose literally any fund. Since you are in control, you should always select the lowest cost fund available. This brings us to the mutual fund versus ETF debate. Both are bundles of stocks. The main difference is how they trade. Mutual funds are bought and sold only once per day after the market closes. This makes them perfect for automatic investing. If you want to automatically move $100 from your bank account into your Roth IRA every week, a mutual fund is the best option because you can buy fractional shares to the penny. Use FXAIX, SWPPX, or VFIX ETFs trade like stocks throughout the day. For S&P 500 exposure, the best ETFs are Vanguard's VU E-shares IVV and State Street's SPY. VOO and IVV are generally cheaper than SPY, with VU being a standout at a 0.03% expense ratio. While ETFs are generally more tax efficient, this doesn't matter in a Roth IRA, which is already tax-free. So, mutual fund or ETF for your Roth. It comes down to preference. If you plan to set up automatic recurring investments of a specific dollar amount, go with the mutual fund. If you want the absolute lowest expense ratio or prefer to trade shares yourself, go with the ETF. They both achieve the same goal. Before we wrap up, let's talk about why this simple decision matters so much. Imagine you save $500 a month. If you do this for 30 years and earn the S&P 500, the average 10% return, you would have put in $180,000. But your account balance would be over $1.1 million. You earned over $900,000 just by letting your money work for you. And if you chose a fund with a 0.50% fee instead of 0.02%, you could lose over $50,000 in future earnings. That's why we obsess over these tiny fees. Let's recap your action plan. For your 401k, log in. Find a low-cost S&P 500 or total stock market index fund with a fee under 0.10% and set your contribution. For your Roth IRA, go to your brokerage, type in FXAIX, SWPPX, or VOO. Buy the one you can trade commission-free and set up automatic contributions. I took a few common questions. First, do I need a bond fund? If you are under the age of 45, you can be 100% in a stock index fund. You only start adding a significant bond allocation, like 10% or 20%, when you get closer to retirement. Next, should I buy individual stocks like Apple or Amazon? For your core retirement accounts, you should be boring and consistent. Keep 90% of the money in the index funds. If you want to speculate on individual stocks, use a separate taxable brokerage account with the other 10%. Don't gamble with your retirement. Finally, the market is down right now. Should I stop investing? Absolutely not. You should be thrilled. When the market is down, you are buying those 500 great American companies at a discount. You won't touch this money for decades. Ignore the daily noise and stick to your plan. This really is the most important lesson in investing. You don't need to be a genius. You need to be patient and cheap. Find the lowest cost S&P 500 or total market index fund your accounts will let you access and contribute consistently. That's it. That's the whole secret. If this video helped you, please hit that like button. It helps me know what content to make next. And if you're new here, subscribe for more simple, actionable financial advice. Now, go execute your plan. Thanks for watching, and I'll see you in the next video.